Yes, built a market, man. Oh my God. No wonder, like, we don't have any kids and stuff. Yeah. Speak about
Okay, I think he left. Okay, yeah, I think he's done with the work. Then he'll leave. He'll make us. He'll make us the host, and then he'll leave. Where did they go?
We'll open all
Yeah.
of them. iCloud storage is full.
Will I delete a few stuff? What if I delete?
Yeah, no, no harm. Can we sort it? Like,
I'll delete the. Should I delete the?
no, that's okay. You know what? Don't worry about it.
We put it to a reasons. Okay. Is this the one? No, no.
Wait,
Today.
did it?
Today's ones.
Today's one?
7:55.
Ah, yeah, these are the ones. Yes. Revision okay. One, yeah. These are the ones.
Shall I put it on the same whiteboard and add on slides?
Yes,
That's
yes.
easy, no?
Yeah, that's it.
Two, three, four, five, six, seven. The order might mess up. So you know the proper order.
Ah, that's good. Don't worry about the order.
So then I'll just put it
Yeah.
on there.
Don't worry about it. So even Lahiru has started this class, but then no one had joined, so we cancelled.
Because there's no use.
Same thing can happen here as well, obviously. They join our small session.
Vertical no separate.
Wait, what's that?
For example, not
No,
this one. Okay.
no.
Oh, okay.
That's it.
My bad.
Yeah.
Already 12.
Let's see. I thought this was getting like, broadcasted on YouTube. No, no.
Oh, they do. They do this.
You do it from.
No, we don't. They do.
Okay. What's that? This is not, no.
We got messed up now.
It's okay, we'll delete the whole, this is not, I don't want that.
You don't want this?
No.
So this is the one you don't want.
No. Yeah, yes. 3 key updates. AFM must answer question. Yeah. So even Excel files, we can open them like on this now.
Yes. Excel files, yeah, you can do it.
Yeah, that. If we open this, yeah. No?
No one has joined.
Let's see.
Oh, not again. Five, 6. Okay, no?
Thank you. We'll see.
Do you think anyone will count physical? No.
Right. Okay. Hello, Dilruk. I think it's just going to be the two of us. Hi, can you hear me clearly? Dilruk, hello. Am I audible? Can you hear me clearly?
Yes, you are audible.
Right, okay. So you're joining from Sri Lanka or India?
Yes, I'm from Sri Lanka.
Right, okay, okay, super. You are sitting for AFM for the very first time or repeating?
The very first time, yes.
Okay, cool. So I think this is going to be like an individual class only. So before we start, let me introduce myself. I'm Rukmal. So I'm a lecturer attached to Premier Partners Institute of Management. So this is an exclusive place for ACCA. So I do subjects related to management pillar and also financial pillar here at PPIM. Also, I'm lecturing in a number of other universities. So I'm attached to PPIM as a visiting lecturer. So my bread and butter has always been finance and investments. Uh, I'm attached to, like I said, a few universities here in Colombo. All my subjects are related to, finance and financial mathematics, actually. So when you talk about investments, there is that component that you can't forget. That is your financial math, right? So that is the area that I have specialized in, right? Okay. So I think that's enough, of me. So we'll, straight away get down to business. So you're here to learn, AFM, right? The basics and the advanced stuff, everything that's related to AFM with questions. That's the primary objective of, doing this particular, revision session. So before I start, I want to walk you through some, very important things that that you have to sort of like remember if you are sitting for exams in December, right? So I'm guessing that you're sitting for exams in December, and that could be the reason why you're like. I'm sure that's the reason why you're here in this class today, right? So if you are sitting for AFM exams, there are three things that you need to remember, right? So let me start with those three things. So there are key updates for AFM exams from September 2024 to June 2025, right? There are three things which have changed, in your paper compared to, papers before September 2024. So these three things, I will walk you through these three things in a way that you can quickly understand, right? So these are very important, very, very important. Maybe you need to make a note or something just the updates, right? So now in AFM, you know that, traditionally in the formula table, you get, three types of tables, right? You get your formulae, right? That's where you have all the formulas Modigliani and Miller, you have Black-Scholes option, pricing theory, all these equations are there in that formula sheet. And then you have your present value table and the annuity factor table. And then number three is your normal distribution table, right? So from September 2024, you're not going to have the standard normal distribution table in your paper, right? So you usually use this normal distribution table for what? For two types of calculations, mainly in AFM. That's your value at risk and Black-Scholes option pricing, calculations, right? So because you don't have the table, value at risk questions and BSOP questions are going to be somewhat easy. Are we clear? So here I'm talking about the impact that this is going to have on you. Value at risk method is going to be easy, right? Because with value at risk, you have the confidence interval level coming into the picture. Now, in the previous years, you had to calculate the confidence interval level, right? Using the normal distribution table. But now, because the table is not going to be there, they will give you the confidence interval level, right? They will, give you all the information to calculate VAR. So you don't have to refer to the normal distribution table. Are we clear? That's update number one. Update number two. People, Dilruk. So uh, it's actually, the equation is your Modigliani and Miller second proposition. So what your examiner has done is he has rearranged the equation, not like completely removed it. He has rearranged it, right? Now, M&M equations are not used in AFM, like, in that frequently. But because they're changing this, I'm guessing that, you will have to use this, M&M equation in questions. Now, this is what you were given back then, like before September 2024, this was the equation that you were given, right? So cost of equity of a geared firm, right, is equal to KEI. So you know the equation, yes? But now this has changed to this, right? There you go. Modigliani and Miller, proposition 2 with taxes. So here, you need to understand this. They have basically rearranged. See, same equation has been rearranged. Second. Same equation has been rearranged here. So this part. So this part, right? This part is basically cost of equity of an ungeared firm, KEI. Are we clear? So here you're looking at cost of equity of a geared firm. So they're rearranging the equation in such a way that you have cost of equity of a geared firm here and cost of equity of an ungeared firm on the right hand side. Are we clear? Right? Okay. So keep that in mind. I think that doing this because now it takes like significant amount of time for you to, do the math in the exam if they test this. So that's why I think they're like, rearranging this and giving you what you call KE of a geared firm and KE of an ungeared firm, right? Okay. So what is the impact to you in the exam because of this change? So you have less working, less algebra, right? You will have to use this equation in APV. We don't know, right? Because now they are changing the equation, they're rearranging the equation. You might have to use it. That's the idea, right? So now, usually in APV questions, what you do is you use CAPM and the asset beta to find cost of equity of an ungeared firm, right? So I hope that you can understand what I'm telling you, right? So this is a revision program. I'm not going to I'm not going to explain everything in class, right? This is just going to be questions and answers. So, in APV, you sometimes have to calculate proxy betas, then you have to calculate, the unlevered, beta, that's your beta of assets. So when doing all that, you might have to use this equation, is what I'm trying to tell you. Okay. Okay. Third update is the Black-Scholes option pricing equation. Now, Black-Scholes option pricing equation is complicated, no? Right? So this calculates the value of a European call option, C, right? So for you to find C, you have to firstly find D1 and D2, right? Once you find D1 and D2, you look those values up from the normal distribution table. But now the normal distribution table is not going to be there in your paper. So therefore, the new equation is simply this, right? So you don't have D1 and D2. You don't need to worry about D1 and D2 at all. Are we clear? So what is the impact? So the examiner basically will give you the BSOP calculator to find the values of BSOP input, right? So you have this BSOP calculator. Now, if you don't know what this BSOP calculator is, I'll show you like a small video. You can look it up, like, again, if you want, like, from the ACCA website. So the exam platform will have the BSOP calculator in it, right? So you will need to, like, plug the values into that calculator, get the answer. Are we clear? So no need to manually calculate BSOP. So you need to practice the BSOP calculator though, right? That's there in the practice platform. Are we clear? Yes. So please make a note of this. The BSOP calculator will be given to you only if there is a, like, BSOP related question in the paper. If you don't see the BSOP calculator, that means BSOP is not tested in your paper, right? Please keep a note of that. See, this will be given to you only if you need it, right? Only if the question is there in the paper. If you don't have a question on BSOP, you're not going to get the calculator, right? So these are the 3 key updates that you need to be aware of when you're sitting for the exam. Okay. Right. That's that. Okay. So these are the videos that you need to watch, that you must watch actually before you sit for the paper, right? So now you know that in professional level, you have professional skills mark coming into the picture, right? Out of 50 marks, right, in your section A, the 50-mark question, out of that 50, 10 marks are there for your professional skills, right? So what are these professional skills, right? So you need to, hold on, you need to, here they talk about professional skills videos. Hold on. AFM professional skills. There you go. I want you to watch these 4 videos, right? You go to your ACCA website, select professional skills, and then in that AFM, so if you go to AFM, like, tab, then you have this professional skills. So this is the AFM tab, right? There you go. So you look at professional skills, right? So here they talk about, like, the skills that should be, reflected, right, in your answer, in the FM paper. So communication, guys, now communication is very simple. There's nothing much, if you watch these 4 videos, you can get a brief idea. You don't need to, like, study these. No, communication is you being able to, like, clearly articulate, your ideas to the, what do you call, the audience. So here the audience will be like the board of directors, the senior level management. Yeah. So when you articulate your ideas, like, you usually do that using written reports. So you need to know how to write a proper report, your language skills, right? Use of professionalism, all that comes under what? Communication, right? That's that, right? If your, if your presentation skills are not that great, so your examiner is going to cut marks from this communication aspect of professional skills. Analysis and evaluation in FM, anyway, you do a lot of analysis and evaluation, right? You're given number of options, so you need to analyze like using different criteria. You have to evaluate pros and cons. Yeah, the impact of external environment on your whatever project undertaking or your mergers and acquisition or whatever, right? So that's that analysis and evaluation. This is, analysis and evaluation is tested in your mathematical part, in your calculation. Then skepticism. Skepticism is you not taking things at face value, right? So you trying to see if there are more things, in the case study, compared to over whatever that they just provide you in the, case study, right? So you need to think beyond. That's skepticism. Questioning attitude. Are we clear, right? So you need to, so now in auditing, you talk about skepticism with professional judgment, right? So here, all of this means that candidates need to apply professional judgment to draw conclusions. You get the idea, yes? Yeah. So, you can't take things at face value. You need to be able to see like through. Yeah. You need to be able to see beyond whatever that's given. That's what is meant by skepticism. And then commercial acumen. So you know that all your questions are tested either within, a profit-making organization context or, not for profit, sort of a context, right? So you need to think of this, in that manner, right? You're looking at profits, you're looking at wealth maximization. Yeah. So, being practical is what is meant by commercial, in other words, right? Having that business sense. Okay. Right. Better to watch these 4 videos actually before reading, reading up on these, because the videos can quickly communicate like whatever that's important under these 4 professional skills. Yeah, very, very important. Apart from that, so the BSOP calculator, that is also here. So let me show you that as well. BSOP calculator. So please look at, this video, go to this, just type BSOP calculate ACCA, how to approach BSOP model from September 2022. Look at the video. Next steps, you go to your practice platform. You can select a question where there is BSOP and then use the BSOP calculator in the practice platform to get an idea. Right, but you have to understand there is a slight difference, slight different. Well, how do I put it? Slight difference in the practice platform and the real exam platform, right? But you just need to get familiar, right? You have to get exposed to these things, right? Even though the layouts are going to be different, because you have some practice, you'll be able to you'll be able to use the calculator comfortably in the exam and answer the question without so much of trouble. That's the point. Yeah, right. So keep this in mind as well. Apart from those 2, now I don't think I have to walk you through your syllabus. So you know that in your section A, right, of the paper, the areas which are tested, right? So if you look at the syllabus, I'm just showing you a snapshot. So your syllabus is divided into mainly how many parts? 5 parts, right? Role of senior financial advisor in the multinational organization, advanced investment appraisal, acquisitions and mergers, corporate reconstruction, and treasury and advanced risk management techniques. This is where you have your hedging techniques coming into the picture. So you need to be very thorough with these 5 areas, right? And then you have professional skills, right? And employability and technology skills. So, that you don't have to like focus, worry too much about employability and technology skills. So professional skills, you're going to like build them, you're going to improve those only with questions, only by answering questions. Otherwise, you're never going to, uh, improve your skills. Keep that in mind. Yeah, right. So there you go. So your section A, 50-mark question can come from like, these 5 areas. Yeah, that's section A. Section B, there you go. So 25 mark will comprise of 20 technical marks and 5 professional marks. There you go. All topics and syllabus sections will be examinable in either section A or section B of the exam, but every exam will have questions which will have a focus on section B and E. So B and E are tested like in everything. That's what they're telling you. So section A, section B. So section A is a 50-mark question, and section B, you have 225 markers, right? Section A question can come from like, these areas. Yeah, A to E. See, at least 2 syllabus areas from A to E. The others are tested in section B, but they can test section like they can test like a similar area in section A and section B both, right? That can happen. So you need to be thorough with the entire syllabus is what they're trying to tell you. Are we clear? Right? See, out of 50, 10 marks are for professional skills. Here, out of 25, 5 marks are for professional skills. Yeah. So you have 10 professional marks coming from section B, 10 professional skills marks coming from section A. Altogether, you have 20, right? You have 20 professional skills mark. Yes. So that's very, very important. Keep that in mind. So as you practice, you're going to improve those skills automatically, right? So if you feel that you're okay with like calculations, evaluations, use of models, right? Then you're okay with what? Analysis and evaluation, right? If you think that you're lagging behind in presentation, like, writing in a very professional language, articulating your ideas to the audience in a way that is very clear and easy to understand, then you need to work on that. Are we clear? Yes. Commercial acumen, like, well, you just need to be practical now. You're at this stage of ACCA, so, for you to get to this stage, your commercial acumen is already there, right? So, but, now in AFM, in any professional skills, professional level exam, the aspect of like being practical is crucial, right? You write like, uh, you know, uh, uh, not so practical like answers, like viewpoints, you don't get marks at all, right? As long as your answers are practical, you get marks. Yeah, right. So keep that in mind. So I walked you through these two, the syllabus and the professional skills. So here, they talk about the professional skills, right? How professional skills are tested in each of your subjects, right? So there you go. Advanced financial management, communication. See, so I want you to like, go through these. Yeah. So you can download this from the ACCA website, not a big deal, right? Have a look. Okay, right. 3 key updates, and that's it. Those are the things that I wanted to like discuss, well, before getting down to questions. Are we clear? Right. Anything that you want to ask at this point? Right. Okay. Okay. So there are a few questions that you have to attempt before you sit for the AFM paper, right? So now there are different questions in your past papers. Yeah. I think it's best that you answer these. There are 16 questions. If you can answer at least like 75% of these before the exam, right, would be better, right? So these 16 questions, actually, there is one whole paper here, 2018. These questions, like, if you practice them, you're going to get like a very good idea about how the examiner tests different areas, like with case studies in your paper. Yeah. So, 16 questions. So if you look at like, the areas, so BSOP, corporate reconstructions, APV, bond valuations, project VA, and MIRR, M&A, international investment appraisal, uh, uh, hedging techniques, interest rate hedging, futures hedging, options hedging. You all like you have all those, what do you call, hedging techniques. So you need to be very thorough of, right? You need to be like, you need to have like a basic idea, right? You can't study and remember all these things, but having a rough idea is very important. Okay, right. So I don't think I have to talk about the importance of you going through the, what do you call, you going through your study hub, right? You know that from next year, Kaplan material is going to become sort of outdated, yeah? So you need to like, the idea is the ACCA wants to like, wants you to switch from Kaplan to what do you call, study hub material. So if you look at the study hub, like the way they have like laid down the syllabus, it's somewhat different to, it's actually very different to what's there in your Kaplan text, right? Uh, I don't know whether you have gone through like, the material in the study hub, look, but my advice is, please do, right? Make sure that you do at least the practice questions in the study hub, right? Because how they structure the like lessons is completely different, right? Referring the study hub, okay, that's good. Yes, and make sure that you practice papers, right? I'm sorry, questions. At the end of each chapter, you have questions. No? Practice them. Okay, right. Okay. Now, where's the other question? Hold on. Okay. So this is what I want to look at today. A basic question on, well, it's not that basic. A basic question on cost of capital, right? You know that cost of capital, WACC, use of, what do you call, those beta equations, gearing, re-gearing, calculating proxy betas, they're very important, right? You can't forget them in AFM, right? So this is like a very good question to refresh your memory on cost of equity, calculating proxy betas and all. Okay. I say we look at, this question with, uh, I say we answer this question to refresh our memory on those. So we have two people now. Hello, Nipune. I think you joined right on time. We can start this question. So this is from a very old paper. So why am I looking at very old papers? That is to, now mainly to refresh your memory, right? We can answer section A questions 50 markers later. AFM has a lot of like theoretical models coming into the picture. So you need to be aware of those models, how to use them, all of that. Yes, right. So we are looking at ACCA 2008, right? The June paper, right? If you look at the requirement, estimate the cost of equity, capital, and weighted average cost of capital for Mercury training. Explain the circumstances where each of these two rates would be used. For 10 marks, they want you to calculate cost of equity and weighted average cost of capital. Right. Now, how do we find cost of equity? What are the methods of calculating cost of equity? Yeah. So we'll look at the question later. What are the methods of calculating cost of equity? Cost of equity. Cost of equity. Cost of equity can be calculated using different models. Yeah. Number one, you have dividend discount. Dividend discount. Yeah. I'll say dividend models. Dividend models. So under dividend models, you have two, right? You have dividend discount and you have dividend growth. Dividend growth, yes. Right. So I know according to dividend discount, price of a share is P0 is equal to D1 over RE. Okay, RE, KE, they're the same thing. So KE is equal to D1 over P0. Yeah. This is how we calculate cost of equity under what? Under dividend discount. Dividend growth, you have P0 D1 over RE minus G, So I'll put KE minus C, RE, KE, it's the same thing, right? Okay. So how do I calculate this? So I want to isolate KE. So how do I do that? Right? So how do I calculate KE? So you take this to the other side. D1. So D1 divided by P0 plus G, that's KE. There you go. This is how we find the cost of equity. Yeah. Then I divide. Yeah. There you go. This is how I calculate KE using the growth model. Right. So you have dividend models, then what? You have the CAPM model, right? CAPM model. CAPM model is where we say KE is equal to RF plus beta into ERM minus RF. This is my CAPM model. What other models do you have to calculate KE? What other models? The other model is M&M, right? M&M. Yeah, M&M. So you know that you have M&M, the first preposition and the second preposition. So under both prepositions, you have, K, cost of equity of a geared firm. Yes, that is what they indicate in the formula sheet as well. But in your questions, M&M equation that is used is M&M 2, the second proposition, M&M with tax. With tax. Right? So you know that equation from before. Let me show you. M&M. Where is that? Ah, there you go. Cost of equity. This is the equation. Yeah. Cost of equity is equal to cost of equity of an ungeared firm plus 1 minus T into KE, KE ungeared minus KD into value of debt over value of equity, right? This is how we calculate it. So let me just say that M&M with taxes, let me say, refer to the handout. Refer to the formula sheet. Formula sheet. Got it. Are we clear, guys? Are you following this, Dilruk and Nipuni? Are you following this? This is how we calculate cost of equity, right? Right. Okay. Okay. So, right. Okay. So you have cost of equity and also WACC. They want you to calculate cost of equity and weighted average cost of capital. Yes. So we know how to calculate WACC. WACC is calculated when you have both debt and equity, right? So WACC, I know it's wealth in equity into KE plus wealth in debt into KD. If there is tax, I know it's KD 1 minus T, right? Right? If you have taxes, so your tax benefits are going to get kicked into the picture. So it's going to be KD into 1 minus T. This is your WACC equation if there is tax. Now, I know WE is like, I have shown WE in a very simplified manner. Let me show you the formula sheet, how they calculate. Let me see. Hold on, guys. Yeah. Right. Asset beta. There you go. This is my WACC equation. Yes. So what I wrote as WE, that's basically this, right? What I wrote as WD, that's basically this VD over VE plus VD, right? So I'm sure you know what I'm talking about. So we can, move on now. So this is what they want me to calculate. Yes, right. Okay. Now, let me give you 5 minutes, right? No, let me give you 10 minutes to read and make like notes of the key information, right? Make notes of the key information, please. Right. This is from 2008, right? 2008 June paper, right? Okay. I'll give you 5 minutes. No, 10 minutes. You guys, are you done reading the question? Are we done reading the question? Okay. Right. Let's go through this together now. Yeah. So what are we looking at? Mercury training was established in 1999. And since that time, it has developed rapidly. The directors are considering either flotation or outright sale of the company. Oh, right. So they are either considering going public or selling the company outright to some other party. Okay. Uh, People established in 1999. So this is 2008. Remember, you're answering the question from 2008 paper. So that's like, what? 1999. So like 9 years. So the company has grown rapidly, like, developed rapidly. They they want to go public or like, sell it off, right? The company provides training for companies in the computer and telecommunications sectors, right? So they provide training. It offers variety of courses ranging from short intensive courses in office software to high-level risk management courses using advanced modeling techniques, right? Okay. It offers variety of courses ranging from short intensive courses in office software to high-level risk management courses using advanced modeling techniques, right? So they are providing computer courses. Mercury employs a number of in-house experts who provide technical materials and other support for the teams that service individual client requirements, right? So they have experts, they provide technical material and other support for the teams, right? That service individual client requirements are. So you have experts and you have like the work teams who go and do the work. The experts, they provide like, the support and technical like material to those teams, right? In recent years, Mercury has diversified into financial sector and now also provides computer simulation systems to companies for valuing acquisitions. So they are into training, but now they have diversified into financial sector, right? So I can see that Mercury has two sectors, right? Training and financial services, right? Financial services, okay. So it's a completely different area. So that's why they are saying that they have diversified. This business now accounts for 1/3 of the company's total revenue. What business? Financial services now accounts for 1/3 of the company's revenue. So therefore, training should be, should be 2/3, yes. If financial services is 1/3, the balance, the rest should be the other sector, right? Okay, now we have an idea about the company's two segments, right? Mercury has 10 million shares, 10 million 50-cent shares in issue, right? So 10 million shares, right? 50 cents, okay? Jupiter is one of the few competitors in Mercury's line of business. We're talking about a competitor. However, Jupiter is involved in the training business. Okay, so they're talking about some competitor. Can we say Jupiter here? Jupiter. So they are only into training. They're only into training. Okay. Jupiter is listed on a small company investment market. So you're looking at a listed company. People, when you read this, I'm sure you would have realized that this Jupiter is a proxy company, right? So a similar business, they have estimated beta how much, right? Training. So beta Jupiter, how much? 1.5, no? 1.5, right? Beta is 1.5. Okay. Jupiter has 50 million shares in issue with market price of 580 cents, right? So 50 million shares, we'll say 50 million shares and 580 cents, no? 580 cents. Yeah, okay. The average beta, they're talking about financial services sector now. The average beta for financial sectors, right? So let me say Jupiter, and on this side, I'll say financial sector. What's the average beta? So beta, I'll say financial sector, beta financial, right? This is how much? Beta 0.9. Average market gearing in the financial services sector is estimated at 25%, right? So beta is 0.9 and average market gearing, right? 0.9. So they tell you gearing as well, gearing. Now, you know that gearing can be calculated in different ways now, right? Usually gearing is debt over equity. Right? This is how you calculate gearing. Sometimes it's debt over debt plus equity. Right? This is total capital, debt capital and equity capital. Here it's just D over E. Now let's see which type of gearing they're talking about. Average market gearing. So what is that? Debt to total market value. We know, guys, yeah, we know market value of a company's value of equity plus value of debt. This is how we calculate market value, yeah? So the equation that they're using should be this one, people. There you go. This is the gearing ratio that they're using, yeah? So what's the gearing? Average market gearing is at 25%, right? So I'll say gearing here, gearing that telling you that it's, oops, that it's 25%, right? Done. Are we clear? So these are the main information, people, that they're telling us. Yeah. So in black, what I have is information related to Mercury. In red, what I have is information related to Jupiter. And then in blue, financial sector, right? Other summary statistics, right? They're telling you net assets, earnings per share, dividends per share, gearing, 5-year historic earnings growth, right? So 5-year history, they're talking about historical growth rate, right, for these two companies. Analysts forecast revenue growth in the training side of business, training side of Mercury's business to be 6% per annum. So they're talking about training, the growth rate, right? Can I say training, let's say growth 6%, right? And here, but financial sector is expected to grow at just 4%, right? So here growth is 4%. 6 and 4%. Are we clear? There you go. 6 and 4%. People, is this clear? Right? Okay. Background information. Equity risk premium 3.5. People, what is equity risk premium? You know, whenever they talk about risk premiums, they're talking about return over and above the risk-free rate. Yes, risk premium. Remember, risk premium is return over and above the risk-free rate. Return over and above risk-free rate. Right? So if I say calculate the risk premium of stock A, right? Risk premium of stock A. Risk premium of A, right? That is basically return of A, right? Expected return, return of A minus the risk-free rate. There you go. This is what is meant by risk premium, guys. Yeah, I'm sure you know this, but then, refreshing your memory. That's all. Yeah. Okay. So they're talking about what? Equity risk premium. What is that? Equity risk premium is basically ERM minus RF. This is my equity risk premium. Equity risk premium, ERM minus RF, that is 3.5%. Okay. And the rate of return on short-dated government stock. People, they're talking about the T-bill rate or the risk-free rate, 4.5. So risk-free rate, how much? 4.5%. Yeah. Last point. Both companies can raise debt at 2.5 above the risk-free rate, right? So they're talking about cost of debt now, right? Cost of debt is how much? Risk-free rate plus 2.5, right? Both companies can raise debt at 2.5 above the risk-free rate. So I'll say KD. KD of Jupiter is equal to KD of, KD of Jupiter. KD, I'll simply say KD is equal to risk-free rate plus 2.5%. So therefore, that's 4.5 plus 2.5, 7%. So cost of debt is 7%. Yeah. Are we clear? Tax on corporate profit, 40%, right? TC, That's 40%. Right. Are we clear, people? These are the information that is given to, like, these are the main information that is given to us. Yeah, right. People, if you're okay with this, then we can start, calculating, like, we can start showing the working. Yes. Okay. Shall we start, people? Shall we start? Are we okay? Right? Okay, cool. Now, right. So, guys, now you have to firstly estimate cost of equity capital, right? Now, cost of equity, obviously, we have to use which model here? What is the model that we have to use? Definitely, I think the CAPM model, because they're talking about betas, they're talking about a competitor company, right? They're talking about a competitor company. They're talking about, like, average financial industry. So I think it's proxy beta, beta, geared beta. I'm sorry, beta. I think we have to re-gear, de-gear betas. That should come into your, like, mind. That should click in your mind, people. Are we clear? Yes, right. So how do we start, people? How do we start? Yeah. Now, okay, people, can we calculate this company's, shall we calculate this company's Jupiters, right? So, guys, now this is what you need to understand. They're talking about Jupiter because using Jupiter, we have to find the beta facets of training industry. Yes. Then using this information, we have to find the beta facets of the financial industry. Are we clear? Yes. Once we have the betas of training and financial services, we can get the overall beta facets of this company. Does that make sense? Does that make sense, people? So they're giving us data relating to proxy companies. So in this case, there's a proxy company and, data relating to an industry, right? So we have to use this data to calculate, beta of the sets, right? Or we have to de-gear, in other words. Are we clear? Is that clear, people? Right. So let me start with Jupiter, right? Let me start with Jupiter. So I'll say Jupiter. Okay, right. So what are we going to calculate firstly? Now, shall we calculate debt and equity values of Jupiter, right? Shall we start with that, right? So Jupiter, I'll say debt and equity. Debt and equity of J. So let me make this working number 1. Let me make this working number 1. Okay. Right. Okay. People, they tell you Jupiter's number of shares, 50 million, and the price is also given, no? Right. So let me calculate value of equity, VE. Value of equity, 50 million into 580 cents, no? So 0.58. 580. Yeah. 580. 50 million into, so that's 29 million people. 29 million. There you go. This is my value of equity of Jupiter. Yeah, value of equity. Now I have to find value of debt, no? To find value of debt, right? So how do I find value of debt? I can use the gearing ratio, yes. They tell you my gearing is how much? Gearing of Jupiter is 12%, no? Gearing of Jupiter is 12%, right? So I'll say gearing. How do I calculate gearing? I know gearing is debt over debt plus equity, right? We figured that out before. See, this is equal to how much? 12%. Now I already know the equity value, right? So I can say D over D plus equity is 29. 29, right? This is equal to 12%. There you go. Now I can find D. I can find D, right? People, do you understand this working? Are we clear on this working? Yeah, please understand what I'm doing right now. So we'll firstly calculate, debt and equity of, Jupiter, so that we can find beta of assets of the training side of Mercury. Yeah. Right. So you simplify this, guys. So you take this to the other side, right? So that's 0.12, 12%. Let me convert that to a decimal. D29. This is equal to D, right? So you simplify this, guys. You get D 3.95 million. This is how much you get. Right? You simplify this, you get D 3.95. Are we clear? Are we clear? Let's show this, please. Show this. Right. Nipuni, I hope that you're following this as well. So there you go, VD done. Yeah. Okay. So this is my value of debt. So now I can say VD is 3.95 million. 3.95 million. $3.95 million. Done. Yeah. Okay. Right. Okay. Now what do I do after this? People, don't forget there is tax here, right? You have taxes in this case. So my WD has to be adjusted to, now this is, now hold on, now, okay. You know what? Let me write the equation. So now I have debt, I have equity. So I can find I think I have all the data for me to calculate my beta, right? So you know that now you anyway have the equation in your formula sheet, right? Where is that? There you go. So this is my asset beta equation, right? So this is what I'm going to write. Yeah. Okay. So I know beta of assets is equal to VE over VE plus VD into KE plus VD, VE plus VD 1 minus T. Here also, please refer to the equation, guys, because your taxes 1 minus T. 1 minus T into KD, right? Yeah. So are we clear? Sorry, this is my asset beta equation. So I'm sorry, guys, I made a small mistake. So this should be beta of equity. 2 people have joined online. Basically, no.
So this meeting.
KE, I'm sorry, guys. This should be beta E, and beta D. And beta D, right? Beta D. Okay. This is 1 minus T. VD 1 minus T. Are we clear? Right? This is my beta versus C equation. Now, I know, unless otherwise stated, beta of debt is always 0. Right? This is always 0, unless otherwise stated. Right? This is always beta debt is 0. Always 0. Right? Always 0. They usually don't give, they don't mention any, beta value for debt. So, if they do, then you have to take it. If they don't mention it, you assume that it's 0. Right? This is a crucial assumption. So I'll say assuming debt beta is 0. Right? So this whole thing ceases to exist now. Right? This is 0, right? Now we'll plug the values into this equation. Value of equity, I know value of equity. We found value of equity 29. 29, yeah. VE is 29. What is VD? We found VD 3.95. 1 minus T. T is 40% taxes, 40%, no? Where did we show that tax? 40%. 0.4. We know the beta of this company as well, no? We know the beta of this company. What is Jupiter's beta? Jupiter's beta is, where is that? 1.5. So you have to assume the beta, that value that they give you is equity beta, right? It's always equity beta, yes. If it's asset beta, then they had to like specifically mention that. So this is 1.5. Done. You simplify this, you get beta of assets of what? Beta of assets of Jupiter. Show this, guys. Yeah, show this. Beta of assets of Jupiter. Okay. So beta of assets, this is 1.387. There you go, 1.387. This is my beta of assets of what? Jupiter. In other words, this is the D gear, right? This is the D gear beta of the training side. So let me say this reflects the business risk of what? Training side. Training sector. And can we say training sector? Done. So we are a bit closer to finding the cost of equity of Mercury. Remember, cost of equity, for you to calculate cost of equity, you firstly have to calculate, the betas, right? So your company is made up of 2 different areas now, right? 2 different sectors, financial sector and the training sector, right? So you combine the 2, that's when you get beta of assets of your company. Then you have to re-gear, right? This is the de-gearing process, guys. Yeah, this is the de-gearing process. Are we clear? Right? Are we okay with this working? If you don't understand, you need to let me know. So I'll slow down and I'll explain. Yeah, not a big deal. Okay, now what? Now what? Now what? Now we'll talk about the financial sector. So Jupiter, the working is done, right? So this is working number 1. Can we say working number 2 for this? Working 2, degearing. Degearing. Degearing beta. Degearing beta. Are we clear? This is the degearing part. Remember, beta debt is always 0. In questions, if they give you a debt beta value, then you have to use it. Otherwise, no. Got it? Right. Moving on. Now what? Now we'll say working number 3. So this is working 2. Now we'll say working 3. Working 3. What's going to be my working 3? We'll find, we have to find the, what do you call, we have to find, we have to do the same thing for financial sector. Same thing, right? So, how do I say that? I'll say financial sector. Financial sector, asset beta. But can we say financial sector? Now, guys, with regards to financial sector, there is a problem, right? We can't do this, right? Why is that? In the financial sector, they're not giving you like equity values because it's, the industry information that they talk about. See, they give you the gearing ratio, they give you the beta, that's it. That's all they, provide us. So I have to like somehow find the asset beta, right? I can't use this method. This method is completely out. What we did before, we can't use it, right? So this gearing, now even if I use this gearing equation, it's not going to work because I don't know any of these values. They don't tell me debt value, they don't tell me equity value, they just talk about the gearing ratio of the financial industry, right? In this case, we had, equity value. So we knew one of these two unknowns, right? So I hope you're clear as to what I'm trying to explain. So they're talking about the gearing. What is the gearing of financial sector? Financial sector gearing 25%. See, 25%. So gearing is basically D over D plus E. This is 25%. Right? Now, we don't know D value, we don't know E value. You don't have these information. Are we clear? Are we clear, guys? Yeah? Are you following this? Any questions up to now? So we can't use this method. Please let me know if you have questions, clear, right? Okay, so we can't use this method, not going to work. So I'll just say, no, we can't use this. Guys, so what can I do? I can use this equation to find this, yeah? So they give me the gearing ratio. They give me the gearing ratio, right? So this gearing is D over D plus E. But since there is tax, right? Since there is tax, I want tax adjusted gearing. So I'm going to say, since there is tax, we need to calculate, we need to have, what do we need to have? Tax adjusted gearing. What the hell is that? Tax adjusted gearing. What is that, guys? Tax adjusted gearing is basically D into 1 minus T over D into 1 minus T plus C. This is my tax adjusted gearing. Tax adjusted gearing. Do you get this? Now this is my normal gearing, D over D plus C. Yeah. But since there is tax, I have to calculate tax adjusted gearing. D into 1 minus T divided by D into 1 minus T plus E. So it's just that I'm plugging 1 minus T into this. That's all. Okay. Are we clear, guys? Right. So how do I find the tax adjusted gearing? So can I say, can I come up with this equation, guys? It's, let me say, uh, uh, how do I show this? Yeah, you know what? I'll say tax adjusted gearing. Tax adjusted gearing is equal to 1 minus T over gearing ratio. This is my non-tax adjusted gearing ratio minus T. Right. Let me minus T. There you go. People, this is how I calculate. Now, tax adjusted gearing is basically this. That is what is meant by, this is what is meant by tax adjusted gearing, is it? This is what is meant by tax adjusted gearing. So how do I calculate that now? I don't have E value, I don't have D value. What I have is only the gearing ratio. That gearing is not adjusted for tax. This is how you calculate the tax adjusted gearing. So now I'm going to say, yeah, now I'm going to say 1 minus T, T is how much? 40%. Gearing ratio, they tell me that gearing ratio is 25%, no? 0.25 minus 0.25 minus, what's the gearing ratio? 1 second, guys. What's my, hold on. Wait, hold on. I made a mistake. Let me do a calculation and see. 0.6 divided by, what's the tax adjusted? Tax adjusted gearing. Hold on, guys. I think I made a mistake. Only calculating. It's plus, guys. Hold on. I think it's plus 0.25. 0.25 plus 0.25 plus 0.65. Wait, huh? Guys, 1 second. 16.67 is my oh, 1 second. One second, guys. 1 second. Check something. One second. Yeah. So, my calculator. 1 sec, guys. Yeah. Nine one two minus 9.4 0.6 divided by 0.2. 0.28, 0.6 divided by, is it reciprocal? Oops, sorry. 0 point. Right, yeah. Guys, I made a small mistake in the equation. That's what I checked. So remember, so this should be gearing ratio. Hold on, let me write the equation just one more time. 1 minus t gearing ratio to the power minus 1, right? Gearing ratio to the power minus 1 minus t, right? Right? Please amend the equation in this way, guys. So therefore, 1 minus t is 0.4, gearing ratio 0.25 to the power minus 1, right? Then minus the tax. Then you get the tax adjusted gearing. So here, this is 0.6, yeah, 0.6, 0.25 to the power minus 1 minus 0.4. This is 3.6 people. This is 3.6. No? So therefore, 0.6 divided by 3.6 people, you're getting 0.1667. Therefore, my tax adjusted gearing is 16.67%. People, please amend this equation, guys, in this way. Sorry, I got stuck with the gearing ratio. Yeah, gearing ratio to the power minus 1. Let's put it like this. Gearing ratio to the power minus 1. Are we clear, guys? Right. So this is my tax adjusted gearing. Please show the working clearly. So you may not have known this equation, people. That's fine. So now you know this. This is how I calculate this is how I estimate my tax adjusted gearing. In other words, that's this. So tax adjusted gearing is what? 0.1667. There you go. Nipuni and Dilruk, are we clear? Right, got it. Okay. Now you need to use your, use your mathematical sense, people. Now, if my tax adjusted gearing, that is d into 1 minus t divided by d into 1 minus t plus e, if that is 0.1667, then by logic, so I'm going to say if d over d into 1 minus t over d into 1 minus t plus e. If this is equal to 16.67, if this is equal to 16.67, well, you know what? Can I show this in decimals? 0.1667. If this is equal to 0.1667, then E over D into 1 minus T plus E. Guys, this is the two components in your what? In your beta equation, right? These are the two equations. These are the two components in the beta equation. See, there you go. VE divided by VE plus VD 1 minus T. So same thing here. I haven't put V. but it's the same thing, right? Yeah, so this should be 1 minus this value, right? 1 minus 0.1667. So you're looking at the proportion of debt and the proportion of equity, right? So what is the proportion of equity? 1 minus 0.1667 is equal to 0.8333. There you go. There you go. Are we clear? So simple, right? The logic is very, it's clever, people. How we derive this by using the logic. Yeah, right. Now I can find the beta. Now I can find beta. Yes. So what do I do? So here I said financial sector. We found the debt and equity, the percentages, right? Now I can use, can we say working number 4? Working for, let me say degearing, right? Same thing what we did before for that Jupiter, degearing beta. Degearing beta. Okay, write the equation again. So I know beta A is equal to VE over VD plus, sorry, when we say VE into VD 1 minus T, this is into beta E plus VD 1 minus T, VE in plus VD 1 minus T into beta D. Yeah. So now I know that this is 0. This is 0. So this whole thing ceases to exist. So therefore, beta of equity of financial sector, beta, they tell me what's the beta of financial sector? Beta is 0.9. There you go, beta financial sector 0.9. We'll put that here, 0.9. What is this component? VE over VE plus, that is what I found using this 0.8333. So let me put that here, 0.8333, 0.8333. What is this? 0.9. People, I'm getting 0.749 something. Is that the beta? Is that the beta? 0.74. Yes, 0.749 something. Yes. Beta of assets. Yeah, right. Up to D. People, I'm getting 0.7499 something. 0.749. So shall we round it off to? So it's 0.7499. So we'll round this off to 0.75. Yeah, 0.75. Done. Okay. Now we are at the last part of this question, people. Right? We are at the last part of this question. So now I have the beta of financial industry and beta of my what's the other industry? The training. Right? Now I can find. So we'll say working number 3, 4. This is working number 5. Working 5. We'll say beta. You can say asset beta of Mercury. Now we have to understand Mercury is not a listed company. That's why we are doing all this, right? So I know Mercury has two segments. No? These are the two segments, yeah? Training and financial services. They tell me the revenue that is coming from financial services. That is 1/3. So we have to assume 1/3 of their business is financial services. So therefore, I can say asset beta of Mercury. So can I say beta of assets? Firstly, I have to find beta of training into what? Size of training. No? The size of training that I'll indicate as W training. Yeah. Plus beta of financial services into what? Wealth in financial services. There you go. This is W, guys. Yeah. This is W. This is W, financial. Right. So beta of training, what was it? 1.38 something, 1.387. 1.387. And I know the size of the training, segment is 2/3. Plus beta of the financial industry, that's 0.75. We know that this represents 1/3 of the business. There you go. This is my answer, people. Right? What's this answer? You're getting 1.177 something. 1.177. This is the what? Asset beta of Mercury. This is the asset beta of Mercury. Are we clear? Are we clear up to this point, people? All good. Right. Asset beta of Mercury. Done and done. Now what? Now what do I do? You tell me, guys. You tell me. What do I do? Use the CAPM, right? Use the CAPM. Using CAPM, now I have the beta of Mercury. Using CAPM, can I calculate my cost of equity? K. RF plus beta into ERM minus RF, yeah. Is this what we do? So risk-free rate is how much? Risk-free rate, I think it was 4.5% something. Risk-free rate was how much? 4.5. Risk-free rate, yeah, see, risk-free rate is 4.5. Equity risk premium is 3.5. Okay. Risk-free rate is 3.5. Better to round things off to decimals, right? Beta 1.177 into ERM minus RF. Sorry, risk-free rate is 4%. No? My bad, guys. Here, risk-free rate is 4.5. 0.045. This is 0.035. Is this the answer? Is this my cost of equity of Mercury? Using CAPM, cost of equity of Mercury. Is this how we calculate cost of equity? People, this is wrong, right? This is wrong. Why is that? Because what I have found as beta is basically the beta of assets, right? In other words, unlevered beta is what I have found. I have to use beta of equity because CAPM is a method of valuing or method of calculating cost of equity. So I have to find beta of equity of what? Mercury. So this answer is wrong, right? So therefore I can say calculating beta equity of Mercury. So what I just showed was like a common mistake that students, do. As soon as they find asset beta, they plug that value to the CAPM equation and calculate the cost of equity. That's wrong. So once you have your beta of assets, you have to find the beta of equity. In other words, what are we doing? We are re-gearing. This is the re-gearing part. Re-gearing. Yeah. So how we re-gear is by adding what? Debt, no? By adding debt into our picture. So I know beta of assets is equal to that same equation. VE over VE plus VE plus VD 1 minus T, this into BE, beta E. Yeah. Plus this is VD over VE plus VD 1 minus T into, this is 1 minus T, don't forget that, into beta D. Are we clear? Are we clear, people? Vipuni and Dilruk, are we clear up to this point? Please understand that you can't calculate CAPM using asset beta. For you to calculate CAPM, you have to have what? Equity beta, right? So now what? Now what are we going to do, people? Now what are we going to do? The same thing that we did for, the same thing that we did for financial industry. So here, guys, they tell you that Mercury has 10 million shares, right? 10 million shares at 50 cents. These are not traded in the market. So if you multiply 10 million by 50 cents, that's wrong, right? This is not VE, right? You can't calculate VE in this way because, this company is not a listed company. Yeah. So what we need to do is we have to use this equation again, right? Tax adjusted gearing, right? So let me show you. So say tax adjusted gearing, tax adjusted gearing of what? Tax adjusted gearing of Mercury. I know tax adjusted gearing is D into 1 minus T over D into 1 minus T plus E. This is what we calculate. So how do we calculate this? We calculate this using 1 minus T gearing to the power minus 1 minus T. There you go. Right? Okay, so 1 minus T is 0.4. Gearing. Gearing of this company, I think they tell us the gearing. No? What is the gearing of Mercury? Gearing of Mercury, there you go, guys, 30%. 30%. So we'll put 30 here. 30%, 0.3 to the power minus 1. No? Minus tax. There you go. This is my tax adjusted gearing. So how much is this? You should be getting 20.45. 20.45. 0.2045. This is 20.45%. Are we clear? Nipuni and Dilruk, I hope that you're clear. Just a small question. Have you ever come across this equation? This tax adjusted gearing, this one. 1 minus t divided by gearing to the power minus 1. Yeah, that's what. That's the reason why I wanted to look at this question. Yeah. What's up? I will switch it on. It's getting a bit warm. Yeah. People, please make a note of this tax adjusted gearing. So using this equation, what we find is basically this. Are we clear? Tax adjusted gearing. Okay, now since I have the tax adjusted gearing, just like before, so I can come up with a if, I can come up with that if logic, if d into 1 minus t divided by d into 1 minus t plus e. If this is equal to 0.2045, if this is that, then E over E plus d into 1 minus t. This should be equal to how much? 1 minus 0.2045, no? The balance. Yeah, the balance is that's 7955. 7955. Right. Are we clear? 7955. Yeah. So now I can use this to calculate what? To calculate beta of equity. I can use that information here. Yeah, okay. Please show this working. Right. Okay. Now, okay, please show this and then we'll plug the values into this. Therefore, beta of assets. I already know the beta of assets now. That's what I calculated, right? Beta of assets. See, beta of assets 1.177, right? I'll put that here. Beta of assets 1.177. This is equal to what? VE over VE plus VD into 1 minus T into beta equity R. I know this part, right? I know this part. VE, that's the same thing, right? How much is that? 0.7955. 7955. What is the beta of equity? Beta of equity is what I want to find. Right? People, are we clear? It's ingenious, right? So we have to do all this crap, man. It's just tedious, but what to do, right? So now we can find beta of equity, divide both sides by 1.177 divided by 0.7955. You're getting 0.479, so we'll say 48. This is the beta of equity of Mercury. Thank God. Thank God. Right? Now I can finally use the CAPM to get the answer. Yes. Clear. People. Guys, now Now, you anyway, when you do revision, you look at recent papers, no? Right? So in these classes, we'll look at those old papers. Now, this is just to refresh your memory, that's all. I can't keep looking at, very old papers, no. Right? So I was going through the papers and I was like, okay, this is a good question to refresh your memory on, cost of equity and all. Yeah. Okay. So now using CAPM, let's find the cost of equity. So KE is equal to risk-free rate is 4.5, 0.045 beta of equity 1.48. This is multiplied by equity risk premium 0.0359. This is my cost of equity of this company. How much is this? People, I'm getting 0.0968. So that's 9.68%. Yeah. Okay. Dilruk and Nipuni, are we clear? Now I have cost of equity. Now I can calculate back. No, I can calculate back, right? So therefore, so the requirement was to calculate what? The requirement was to calculate cost of equity and weighted average cost of capital, right? Now say back. What is back? Back is equal to, so we can say value of equity over value of debt into 1 minus T into cost of equity, right? And then value of debt, VE plus VD. So please look at the WACC equation. WACC equation, there you go. Yeah, WACC equation. So it's, the guy made a mistake. There's no 1 minus T. 1 minus T comes only in beta. This is VD. Yeah, no. Okay. Beta A. 79. Back. 80. That guy is over. PE plus over E over, oh gosh, oh my god, what just happened? What just happened? Oh, VE VD plus VE into KE plus this is VD plus VE into KD 1 minus T. Right? Okay. People, now here you're looking at VD over VD plus VE, right? Look at this syllable, look at this component, please. This component, you have to understand. I've written the same thing, like, what do I mean by the same thing? This same thing, right? This same thing. Where is that? Without 1 minus T. So this is my ungeared. What is this? Ungeared gearing. I'm sorry, this is my non-tax adjusted gearing. I'm sorry, my bad. So you don't have 1 minus T here. So this is my non-tax adjusted gearing. I know the non-tax adjusted gearing anyway, right? They tell me the gearing of this company is 30%. See, 30%. Right. This is, I got confused, guys. Hold on. So this is 30%. So gearing is 30%. Cost of debt, we found cost of debt before, no? Cost of debt was how much? Cost of debt, there you go, 7%. Cost of debt is 4.5. Risk-free rate 4.5. Yeah, that's what they said, no? Both companies can raise debt at 2.5 above the risk-free rate. So 2.5 plus 4.5, that's 7%. That is 7%. So you put 7% here, 0.3, 0.07, 1 minus T. T is 0.4. This is my debt. Right? This is my weighted average cost of debt. Weighted average cost of equity. So if debt is 0.3, then weight in equity should be 0.7. Right? This into cost of equity 0.0968. People, this is my WACC. Are we clear? This is my WACC. So you finally have to get what should be the answer here. WACC is 8.04 something, people. 8%. People, please let me know if you have any doubts so that I can clarify. So in the WACC equation, guys, in the cost of capital equation, you don't have 1 minus T coming into the picture. I got confused there because all this time we had that 1 minus T after, VD, right? After VD, we had 1 minus T. So I got confused. So, in the WACC equation, 1 minus T is there only with KD, not VD, right? So that's why I paused people. Okay. Are we clear on this, people? So for 10 marks, this is what you need to do. Are we clear? Hmm? Vipuli, all good? Right? Dilruk, everything is clear? Okay, solid. Okay. Right. Okay, part B of this question. What do they ask me to do in part B? Where is part B? There's a part B as well. Hold on. Wait. I think I have to open this on Excel. 1 second. Part B. This is part B, guys. Yeah. Let's look at part B. Advise owners of Mercury training on a range of likely issue prices for the company. Right. Advise the owners of Mercury trading on a range of likely issue prices. Now, what are they telling you? People, do you see that in the very first paragraph, they said that the directors of this company, they're considering either a flotation or an outright sale of the company, right? The very first paragraph, see, flotation or outright sale of the company. So now they want me to calculate what likely issue prices for the company. Issue prices, right? So meaning they are asking me to value the company. Do you understand? Now, in your business valuations chapter, you talk about different ways of valuing companies now, right? You talk about different ways of valuing companies. You have free cash flow method, you have multiple based, valuations, you have asset based valuations, dividend based valuations, you have a hell of a lot of different types of valuation models. Yeah, now you have to use those models in this case. Are we clear? So to find the price of a share of this company, what models can we use is what they're testing with this 10-mark question. Right? Okay. Keep that in mind. Let's go back to the question. So I will erase this working. Erasing everything, yeah? Right. Okay. People, so I have found the cost of equity and I found the WACC as well. So I'll just show them here. Cost of equity was 9.68% something. And then WACC was 8%. WACC was 8%, right? Done. Okay, likely issue prices now, right? So they are thinking either flotation or outright sale, no? Outright sale. Yes, right. People, now, how do you value businesses, right? So, business valuation models. Business valuation, right? So you have, I'm just going to, show you some of these models, business valuation. You have multiple based, that's your PE and whatnot, multiple based. You have asset based, you have dividend based valuations, you have free cash flow based valuations, different valuation types of them. Now we have to use, some of these models to calculate the share, right? People, do you see that they talk about net asset value? Net asset value. Net asset value is basically your, value of the company after deducting debt. Net asset value is after deducting debt, right? Mercury's value is 65 million. People, I want you to go back to those notes if you can't remember. Asset-based valuations can be used to understand or can be used to get an idea of the lowest value. Like, a company can charge from a, potential person, right? So this company has assets, net assets worth of 65 million. That is the value, right? They have assets after deducting debtor. So net asset value of 65 million. So that's like the lowest price that they can charge it, right? Lowest price. Yes. Under set-based valuations, you have the net asset value, NAV, right? NAV indicates the lowest value, lowest possible price, lowest possible, right? So 65 million is the lowest possible price that company can charge if they are selling the company to another party, right? So they want the issue price. This is the total value, 65 million. Per share, it's 65 million divided by 10 million because this company has 10 million shares, yeah? So they can charge 6.5 $6.5, right? In other words, they can charge, this should be multiplied by 100, no? 650 cents, no? 650 cents, right? In cents. Now they're talking like in cents now. In the question, 50 cents, 580 cents, like that. So in cents, they can charge 650. This is if they're selling the company, right? If selling the company outright, if selling the company to an outside party outright. Are we clear, guys? Are we clear? Nipuni and Dilruk, are we clear? So there you go. Net asset value, right? Yeah, lowest possible price, 65 million. So we want price per share. Price per share. Yeah. Okay. If selling the company to an outside party outright. Okay, what else? People, they're talking about dividends. No, they're talking about dividends, right? I can surely use dividend models in this case, right? Now, they want you to calculate like range of prices, likely range of likelihood prices. So you have to calculate number of prices. One is not enough, right? Using dividend model, I can definitely use the dividend model. Which dividend model? The normal dividend discount model or the growth? They're talking about, growth in different places. So I can use dividend growth or Gordon's growth model. Gordon's growth. I know Gordon's growth model, the price is equal to D1 over RE minus G, right? D1 over RE minus G. I can write this in a different way, D0 into 1 plus G over RE minus G. You can write the same equation, this equation in this way as well. Yeah? So D1 is with growth. D0 is without growth. So you manually add the growth. That is 1 plus G. Are we clear? I can definitely use this model. You understand that? Okay. So do you see that they're talking about the 5-year historic growth rate of more than 12%? Right. So let me say, right? Let me say, using historic growth. What is my historic growth? Historic growth is 12%, right? If you assume that you're going to grow at the same growth rate, right? Then the growth rate is going to be 12%. So historically, annual growth rate over the last 5 years has been 12%. So you're going to use that same assumption. I'll grow at 12% even into the future. People, if I use this, then what's going to be the share price? Shall we calculate the share price? Right. Okay. T0, right? T0 is equal to dividend per share. People, they give you the dividend per share, right? Dividend per share, 25 cents. People, other summary statistics for both companies for the year ended 31st December 2007, right? December 2007, I think you're looking at like current year data. December 2007, I think you're looking at current year data. Current year. This is current year. Yeah, current year. Because this paper, you're looking at 2008. So current right now, the dividend per share is 25%. Yeah, 25%. 25 cents. 25. This is going to grow at how much? 12%. 1.2. Yeah, divided by what's my cost of equity? People, cost of equity, we found it 9.68. 0.0968 minus what is the growth rate 12%. People, do you see that this equation is not going to work? Why? See, your denominator is going to be minus. In other words, your growth rate is greater than the cost of equity. Does that make sense? Right? So I'm going to say G greater than cost of equity. Therefore, this equation does not hold. This equation does not hold. Does not hold. Therefore, this growth rate can't be used, is what I'm trying to tell you. You have to show this to the exam. Look here, I tried to calculate the share price using this historic growth rate, but it doesn't work. Are we clear? Are we clear? Are we clear? Nipuni and Dilrukh, are we clear? Right. Okay. Now they're talking about other growth rates. We'll use them. People, they tell you analysts forecast revenue growth in the training side 6%, growth in this financial services 4%. Right. Okay. No big deal. We'll use that. Using analysts forecasts. Right. Training growth rate is how much? Let's say T. Growth rate is 6%, financial sector 4%. Now, this company is made up of two things, right? So, what is the wealth? What is the size of the training sector? 2/3. What is the size of the financial sector? 1/3. Yeah. So, therefore, average growth 6%, 0.06 is coming from training. Size of training, like the what do you call the revenue that you're getting from training. So using that logic only, we find this 2/3, right? What is the growth of financial? 4%, and they said size of financial sector is 1/3. There you go. This is my average growth. Yeah. Average growth rate, right? So 0.06. How much is this, people? 2/3. That's 0.667 into 0.06. This is 0.04 plus. This is 1/3 into 0.04. That's 0.0133. So This is 0.04. Growth rate is 0.0533. Right. There you go. Now I can use the equation to calculate the share price. EPS 25 cents. 25. So you can say 0.25. Even here, we can say 0.25. 25 cents. No? Yeah. 25, right? 25 cents. No. No, we are going with cents now. So remove this, what do you call, zero. Doesn't make any sense. $25. So what is the growth rate? 0.0533 divided by what? Cost of equity is? Cost of equity is 0.0968. Now this works, yeah. Now we can find the share price. You find the share price, people. Right? This works. Are we clear? We can use this 0.0968. Yeah. And then people, they're talking about earnings per share. See, earnings per share. People, can you remember this equation? Let me show you this thing. G equals Gordon's growth approximation. So you can manually calculate the growth rate. Now, we simply used growth rates which were there in the questions, right? They were already there. We can calculate a growth rate. This is called what? Implied growth rate, right? Implied growth rate. Okay, so let's use that now. Yeah. So implied growth rate. Using, right, another growth rate. Yeah. I hope the two of you are clear with this. Using implied growth rate. Using implied growth rate. So that is what? G is equal to B into RE. Right? B into RE. I know RE and KE, they're the same thing. You know, if they, unless otherwise stated. RE, cost of equity, and return to equity, they're the same thing. What is B? B is my retention ratio. Retention ratio, right? B is my retention ratio. How much you retain, right? So they tell me earnings per share, EPS is 100. EPS is 100. Their dividends are how much? 25. So their retention, in other words, this is my plowback. Retention is 75. Right? So as a percentage, what is my payout ratio? Payout ratio is 25%. Retention ratio is 75%. Retention ratio is 75%. There you go. This is what I use, people. So therefore, I can calculate my growth rate manually. B is my retention ratio. Retention ratio is 75, right? 0.75. Cost of equity 0.0968. Use this growth rate, people. Yeah. How much is this? 0.075 into 0.0968. This is 0.0726. 7.26. Mr. Dilrup can Nipuni, are we clear? Are we clear? So you can calculate, yeah, different growth rates here, right? Okay, now we'll calculate the share price. So share price P0, 25 cents into 1 plus growth rate is 0.0726. divided by KE 0.09 what? 968. 0.0968 minus 0.05, sorry, 726. So because here you have a lower denominator, share price should be higher, right? This share price should be higher than this share price. Let's calculate it. 25 into 1.0726. 26,815 divided by getting 110805. So guys, I think this is $11 if I'm not mistaken. $11. I think we need to use 0.25 people because it's 25 cents. 25 cents, yeah. Yeah. We need to divide this by 100. No? Yes. Yeah. To get the dollar, this is in cents. You're getting in cents. So to get the dollar value, 1008.05 divided by 100, that's your dollar value, 11.08. There you go, 11.08. So what is the share price here? Get the share price, guys. Yeah. Get the share price. Right? Are we clear? So what's the share price here, guys? Can you give me the value for this one, the red color, marking? What is the share price there? Right? Can you get this price, please? 25 into 1 plus. Twenty-five into 1 plus 0.0533 divided by 0.0968 minus 0.0533. What's that value, please? Yeah. Anyway, now you get the point, yeah. So when the examiner asks you to calculate a range of issue prices, calculating one is not enough, right? You need to use whatever the data to calculate a number of different prices. Even if you can't calculate, now for example, in this, using historic growth rate, you couldn't calculate the share price because the equation doesn't hold. The math is not whole thing in that scenario, yes? So say that, right? Don't be like, okay, you can't calculate it, so it's minus, no need to show it. No, show it. So we can't use the historic growth rate, right? We can't assume the company is going to grow at that rate. Are we clear? Okay. So there you go. You have, I think, 3 different prices, no? So we have 650 here, and then something here, and then here, 11.0. So you have 3 different prices that you can calculate, yes? Yeah, okay. Now, advise, no? Advise. So you have to, you have to go one step further. This is the evaluation part. Analysis and evaluation, this is that. Now you need to advise, right? So obviously you're going to say, look here, this 650 cents that we calculated, keep that as a, a benchmark. Okay, this is the lowest price, $6.5 in other words. And this is the lowest price. We are never going to charge that price. No. Yeah, no. What we charge is the market. So we have calculated 2 prices, right? 11.08 and this one. I don't know what this price is, but this is definitely less than 11.08. I know that, right? Definitely less than 11.08. So I think I'm going to use the higher price. I'm going to use the higher price because this makes more sense, right? Here I'm like taking the average of the 2 growth rates, and that's just crazy, right? Here I'm using a proper, theory, proper model, Gordon's growth approximation, right? To get the share price. So I think I'll start with this, right? So when I negotiate, right? Okay, firstly, now they're considering 2 things, guys. They are considering flotation or outright sale of the company. If they're going to float in the market, meaning if they're going to issue shares, I think the share price should be 11.08, right? If floated, then what's the price? Then 11.08 is more appropriate. Yes, if they're going to float, that is appropriate. Are we clear? This is more appropriate. If they are now, obviously, you're not going to charge anything that is below 11.08. No, right? You're never going to charge that 65, 650 cents. No. If floated there. Now, if you are selling, if the company sold, then what? If the company sold, then what? Then what people? You have to charge something higher. You have to charge something higher, right? So here you are using the dividend model, right? If you are selling the company, then you need to think about from the purchaser's perspective, right? So if a company is buying my company, that company is surely getting a benefit, right? You have to think that way. If there is a company interested in my company, that's because they are getting some benefit, right? That benefit could be what? Could be, I don't know, higher sales, higher, I don't know, they're getting new customers, new technology. I have like a lot of expert people in my company. So it could be, I don't know, a cost reduction. People, what I'm trying to say is the purchaser will get what? Synergies, will be able to enjoy synergies. Are we clear? The purchaser will be able to enjoy synergies. Do you get it? So now we have to think, okay, if they're getting synergies, then I also have to get a part of it when I sell my company, right? People, in mergers and acquisitions, right? We talk about these things, yeah? When we validate the company, post-acquisition, can you remember? Yeah. Anyway, we'll touch upon those things later. We'll do those valuations later in our next few revision classes. So if the company is sold, you can say acquirer will benefit. Otherwise, the acquirer is not going to purchase the company. He's going to purchase because there is a benefit. Acquirer will benefit, right? So benefiting in what way? Will benefit in terms of what? Synergies. They'll get synergies. It's very important that you plug this word like in your answer, right? They'll get synergies. What kind of synergies? You have different synergies, yeah? You have revenue synergies, you have cost synergies, right? They'll get these synergies. Therefore, you need to charge a premium. So you can say, therefore, Mercury has to charge a premium. Has to charge a premium. A premium. Do you get it? Are we clear? So, what is this premium? Guys, your premium usually varies around 15 to 30%. Yeah, I think it's 15 to 30%. Let me check. Usually this varies around 30 to 50%, right? So therefore premium, let's say premium is usually 30 to 50%. 30 to oh, wait, what the hell? What happened? What happened to that working? What is he? What's this happened? It is. Oh my God. Anyway, so there. Thank you. It's that. Right, 30 to 50%. So therefore, what's going to be your starting price? Usually premium is 30 to 50%. Therefore, starting price 11.08 is the market value of the company, right? Or the price of shares using dividends. This into, I don't know. So 30 to 50%. So we'll take the average of this. This is 80% divided by 240, right? I'll take 40%. Point. So therefore, starting price should be how much? 11.08 into 1.4. People, it should be around 15.512. This is what you should quote if you're selling the company outright in the market. Are we clear? Starting price for negotiations. This is the starting price. Are we clear? Does this make sense, people? Nipulian will. Are we clear? 10 marks. There you go. This is your advice. You're not making a recommendation. This is simply, you're advising the board of management, board of directors. This is what you need to consider. Okay, done. Last part of the question, people, that is what? For 8 marks, discuss advantages and disadvantages to the directors of Mercury Training of a public listing versus and private equity finance as what? Private equity finance as a means of disposing of their interest in the right? That's straight theory, right? Discuss advantages, disadvantages of what? If they go public, what are the advantages, disadvantages? Like off the top of my head, I can say, going public is solid, right? You're going to attract a lot of attention in the market, a lot of investors. It's a very easy way of amassing a lot of capital within a very short period of time. But it's a very lengthy process. You have sponsors, underwriters, so many parties involved, right? Getting the right price, the right time to issue, it's all, big problems, right? And there are so many parties involved. You have to pay them, right? Fees. It's lengthy, it's costly, right? And if the issue price is not right, you're not going to get that capital that you want, right? What else? Once you get listed, you have to abide by all kinds of rules, man, because listed companies are governed like in another level. There you go. Are we clear? Yes, those are pros and cons. So pros and cons of listing. Then you have pros and cons of private equity. What is that private equity fund? So you selling the company, I don't know, to a venture capital firm, right? So that's very easy, right? You don't have a lot of, regulations. These companies, they come and purchase, the company. If the company shows good prospects, good growth prospects, yeah. But then people, when you sell the company to a private equity firm, they are going to want like a lot of they're going to, how do I put it? The ownership stake that you have to give up is going to be very high. Now, when you go public, right, you can keep shares for yourself as the founder, right? Look at Google, right? So Google, it's a public company in the United States, but you have founder shares. No one can buy those shares, right? No one can do anything to those shares, actually, right? Same thing with any other listed company, people. You have like founder shares, right? They're like frozen. You can't do anything to them. If you want to, let's say, drive out, the founders, well, you can't, right? The legislation, prevents that. But if you're selling the company to a venture capital firm, no, they'll say, okay, we need 90% of your company, like that. Do you get it? This is straight theory. Discuss advantages, disadvantages. So your tone, right? You can't simply write some points. No, you have to come up with a good answer, right? Argue back and forth. Look here, going public is great, way to get attention, like a lot of capital within like a short period of time, but at what cost? Like that, you need to, properly come up with some solid points, right? You have to come up with a few solid points and structure the answer. Are we clear? Are we clear? Nipuni and Dilruk? Are we clear? So, guys, now, the reason why I did this question was to refresh your memory on on these cost of capital, WACC and all that. But you have to understand there are so many things that we did not look at. Right? So many things, right? So, we looked at just like a few aspects related to, WACC. But I hope that you understood this question. I hope that you learned something that you didn't know in this class, right? In this, during these 3 hours. Are we clear? I say we look at, some more questions in our next, revision class. So will be on Saturday from 12 to 3. So today I took like 45 minutes to walk you through those basics, the things that you need to do, how you need to prepare. It's all like past paper questions. You have to like, if you want to, pass this subject the first time, there are a few questions that you need to attempt. I showed it like at the beginning of this class, right? I'll show them even like, in the next week. So from all papers, when you practice, you touch upon these like small things, that may not be there in your like recent papers. So this is a great way to refresh your memory if you can't remember anything, right? Always look at all past papers, old ones. Yeah. Are we clear? I was actually planning to look at another question on APV, right? We'll do that next week. Are we clear, people? Dilruk and Nipuni, thank you for joining this class. Is everything okay with you too? Did you understand whatever that we discussed in this, during these 3 hours? Yeah. Right. Super. Thank you, Dilruk. Okay. So join the class even next week. I'll look at like these basic things. Now I don't want to straight away start with like 50 mark 50 marks. I'll do that like later, right? These key areas, I think I need to look at them like with some like small questions, like then you can work on you. You get it? You can work on you. Right? So please, if you're sitting for exams in December, you know that this is going to be, this is one time, yeah, as in like one class a week. Clearly not enough. You need to do things on your practice, right? If you can't remember, go back, like, download those old papers that they are even in the ACCA platform, the website, download them, practice them to refresh your memory. Okay. Right. Okay, guys, thank you so much for joining the class. I'll see you guys on next Saturday then. 12 to 3. Okay. Thank you. Right. No problem. No problem.